March 2026. The financial headlines shouldn't be possible, yet there they are. For the first time in the modern era, the total market capitalization of silver, a relic of the earth, has surpassed Nvidia, the undisputed king of the digital frontier. To the casual observer, this looks like a market fluke. But to those tracking the data as of late 2024, this wasn't a crash. It was the Great Recalibration. For over a decade, the global economy retreated into a digital hall of mirrors, valuing bits over atoms. We convinced ourselves that wealth was purely intangible: SaaS multiples, AI hallucinations, and GPU clusters. However, industry reports from the Silver Institute indicate a persistent and widening structural deficit that the market ignored for too long. Analysts suggest that the very infrastructure of the AI revolution, the H100s and the next-generation Blackwell chips, relies on the unique, irreplaceable conductivity of silver. You simply cannot have the digital bit without the physical atom. As of late 2024, the paper-to-physical ratio on global exchanges reached levels that many macro analysts described as a systemic powder keg. While billions of ounces trade on paper screens daily, the actual physical inventory in COMEX and LBMA vaults has been trending toward multi-year lows. The Great Recalibration is the moment the world stops pricing silver based on speculative paper contracts and starts pricing it based on its physical scarcity. This is the transition from a decade of digital excess back to the uncompromising reality of hard assets. In this narrative, the flip isn't just a market event, it's the inevitable return of the physical world. History suggests that while you can print currency and inflate stock multiples, you cannot conjure the silver required to power the future out of thin air. The atoms have finally surpassed the bits. Welcome to the intellectual lifeboat. While the financial mainstream remains fixated on the flashing green lights of the NASDAQ, we are tracking the structural tectonic plates shifting beneath the surface. You are here because you recognize a truth that the paper world is desperate to ignore. The digital empire is built on a physical foundation that is currently being hollowed out. As of late 2024, the divergence between paper silver claims and physical vault reality has reached a historic threshold. Most investors see Nvidia's dominance as a permanent feature of the global landscape. They see the bits, but we see the atoms, the irreplaceable silver conductivity required for every Blackwell chip and AI server. We aren't here for the hype cycle, we are here for the data. By analyzing the Silver Institute's 2024 interim reports and the dwindling registered inventories at the COMEX, we are identifying a framework for evaluating what we call the Great Recalibration. This isn't just about a price target, it's about understanding the inevitable return of physical scarcity. You are positioning yourself among the few who see the rotation before the masses realize the exit is narrowing. Let's look at the numbers. To understand why silver is the shadow king of the AI boom, we must look past the software and into the hardware. For years, the market has treated artificial intelligence as an ethereal, cloud-based phenomenon, something existing purely in the realm of bits. But the reality is that the cloud is a massive energy-hungry collection of physical structures. As of late 2024, the narrative is shifting. You cannot have the AI revolution without the invisible infrastructure, and that infrastructure is built on silver. While investors focus on Nvidia's software ecosystem, engineers are focused on thermal management and signal integrity. Silver possesses the highest electrical and thermal conductivity of any element on the periodic table. In the high-stakes world of AI chip manufacturing, there is no substitute. Industry reports indicate that every Nvidia H100 and the next-generation Blackwell B200 clusters rely on silver-coated components and advanced silver solder to maintain performance under extreme heat. Analysts suggest that as these data centers scale from thousands to millions of GPUs, the demand for industrial-grade silver is no longer a linear trend. It is becoming parabolic. However, the invisible infrastructure extends far beyond the chip itself. AI data centers are projected to consume a staggering percentage of the global power grid. To support this, the world is undergoing a massive transition toward renewable energy and upgraded electrical grids. According to the Silver Institute's interim 2024 data, the solar industry alone, which uses silver paste for photovoltaic cells, is consuming record amounts of the annual supply. When you combine the silver required for AI computing power with the silver required to generate the electricity for those computers, you realize that silver is the master resource of the 21st century. This industrial necessity creates what macro analysts call a logical floor for our $200 target. Unlike a speculative tech stock that can go to zero if the hype fades, silver is a physical requirement for the modern world. If the price remains suppressed by paper trading, the physical supply simply vanishes into industrial products. Based on trailing data from Q3 2024, we are currently in the fourth consecutive year of a structural silver deficit. We are literally consuming the Earth's savings account of silver to build out the digital frontier. History shows that when a critical industrial input faces a supply cliff, the price doesn't just rise, it breaks. By March 2026, the market may finally realize that the AI revolution is physically capped by the availability of silver. The Great Recalibration occurs when the world realizes that bits are infinite, but the atoms required to run them are finite. If Nvidia is the brain of the AI era, silver is the nervous system. Without it, the system goes dark. This isn't just a price prediction, it's a recognition of physical reality. The paper to physical ratio we've monitored throughout late 2024 suggests that the exchange-held inventories are being hollowed out to feed this invisible infrastructure. When the vaults finally signal a true shortage, the logical floor will give way to a vertical climb as industrial giants scramble to secure what remains of the master resource. To understand where we are going by March 2026, we have to exercise the ghost of $50 silver. In January 1980, silver famously touched the $50 mark during the Hunt brothers squeeze. For decades, the financial media has treated $50 as a psychological ceiling, an all-time high, that represents the absolute limit of silver's value. But this is a mathematical illusion. When we adjust that 1980 peak for the sheer volume of currency debasement that has occurred since, the $50 ghost begins to vanish, replaced by a much more staggering reality. Let's look at the secret math of the M2 money supply. According to historical data from the St. Louis Fed, the M2 money supply in early 1980 sat at roughly $1.5 trillion. As of late 2024, that same metric has surged to over $21 trillion. We are currently living in an economy with over 14 times more currency in circulation than existed when silver hit its historic peak. Analysts suggest that if silver were to simply track the expansion of the money supply since 1980, a nominal power match of that peak would project a price well north of $600 per ounce. From this perspective, our $200 target isn't an aggressive moonshot. It is a conservative reversion to the mean that accounts for only a fraction of the total currency debasement. Then there's the matter of how we measure the loss of purchasing power. The official Consumer Price Index, CPI, has undergone multiple methodological shifts since the 1980s, increasingly utilizing substitution and hedonics, which many critics argue understate the true rising cost of living. If we apply the shadow stats methodology, which calculates inflation using the original 1980 formula, the numbers become even more disconnected from the prices we see on screen today. Based on trailing data through Q3 2024, adjusting the 1980 high using a consistent 1980 basis CPI suggests that in real purchasing power, silver would need to exceed $180 today just to break even with its 40-year-old record. In this context, the current price of silver isn't just low, it is a historical anomaly. We are essentially being offered the opportunity to buy a critical 21st century industrial asset at prices that, when adjusted for inflation, are lower than they were during the Great Depression. Unlike the 1980 spike, which was driven by a temporary attempt to corner the market, the 2024-2026 trajectory is grounded in a structural industrial-led deficit. We are witnessing the convergence of the most aggressive monetary expansion in human history with the most significant industrial supply crunch in the history of the silver market. Industry reports indicate that for the last 4 years, the world has consumed more silver than it has produced, hollowing out the very vaults that the paper market relies on for price discovery. As we look toward the March 2026 delivery window, the secret math reveals a massive valuation gap that the market has yet to close. While the mainstream waits for silver to reach $50, they fail to realize that, in real terms, silver is currently trading at a massive discount to its historical value. The $200 target is not a prediction of a speculative bubble. It is a projection of what happens when the paper price is finally forced to reconcile with the reality of a devalued dollar and a vanishing physical supply. When the paper-to-physical ratio finally breaks, we aren't just looking for a new high, we are looking for the market to finally acknowledge 4 decades of accumulated inflation. The ghost of $50 is about to be replaced by the reality of triple digits. While the secret math of inflation sets the stage for a price reset, the actual mechanics of the flip are found in the vaults of the comics. To understand why a delivery failure is viewed by some as a mathematical probability rather than a mere theory, we must look at the divergence between registered and eligible silver. As of late 2024, CME Group inventory reports indicate a systemic tightening of the supply actually available for trade. In the world of the COMEX, eligible. Silver refers to metal that meets the exchange's purity requirements and is stored in an approved vault, but it is not currently offered for sale. It is private property, often held by long-term investors or institutions. Registered silver, however, is the metal that has been warranted and is sitting ready to satisfy a futures contract. This is the only silver that matters when a buyer stands for delivery. Analysts suggest that the ratio of paper claims to this registered silver has reached historic extremes. While thousands of paper ounces change hands every second, only a tiny fraction of that silver physically exists in the registered category. The 60-day delivery window represents a theoretical stress test for this entire system. Typically, futures contracts are rolled over or settled in cash, but as the industrial deficit grows, more participants are opting for physical delivery to secure supply for AI and green energy infrastructure. If a surge of long holders demands physical bars simultaneously, the exchange enters what is known as a delivery squeeze. Based on current depletion rates, the 60-day window is the fuse. If the registered inventory is exhausted during this period, the exchange is forced into a mechanical crisis. This is where force majeure clauses and emergency rules come into play. Exchange rulebooks provide frameworks for dealing with emergencies, including situations where physical delivery becomes impossible. In such a scenario, the exchange may trigger a cash settlement-only mandate. This would effectively decouple the paper price from the physical price. While the paper contract might be settled at a fixed dollar rate, the physical metal would vanish from the open market, reappearing only in private transactions at a massive premium. Industry reports indicate that the paper-to-physical ratio is a metric that transforms a simple price prediction into a warning about counterparty risk. If the vaults signal a true shortage by March 2026, those holding paper contracts may find that they don't own silver at all. They own a promise that the exchange can no longer keep. This analysis reflects a hypothetical market scenario, but the historical data from late 2024 suggests that the cracks in the COMEX are no longer just theoretical. They are structural. When the mechanics of delivery fail, the logical floor of silver S value is replaced by the reality of a physical vacuum, launching the price into a vertical trajectory as the paper market reaches its breaking point. The cracks in the COMEX are not happening in a vacuum. As of late 2024, the depletion of Western silver vaults is increasingly viewed by analysts as part of a broader geopolitical silver grab led by the BRICS nations. While the U.S. markets remain focused on paper contracts and digital derivatives, the East is prioritizing physical accumulation. In the wake of the October 2024 BRICS summit in Kazan, official declarations underscored a collective move toward a decentralized, multipolar financial system. Central to this strategy is the development of frameworks for a precious metal-backed trade system designed to bypass traditional dollar-denominated clearinghouses. While gold has historically been the primary focus of central bank reserves, industry reports indicate a significant uptick in the movement of physical silver toward Eastern exchanges, specifically the Shanghai Gold Exchange. This shift represents more than a change in investment preference. It is a fundamental restructuring of how hard assets are valued. Historically, the COMEX has served as the global center for price discovery. However, as of late 2024, we are witnessing a price bifurcation, where physical premiums in the East are consistently higher than the paper price in the West. This arbitrage is essentially sucking physical liquidity out of London and New York, moving it into vaults that do not utilize the same rehypothecation or paper leverage structures prevalent in Western exchanges. Many institutional analysts are observing this divergence as a strategic play by the BRICS Plus alliance to secure the key atomic infrastructure, required for the next industrial age. By controlling the physical supply of silver, an asset irreplaceable in both military hardware and AI infrastructure, these nations are positioning themselves to dictate the terms of future trade. The 60-day delivery window isn't just a technical glitch. It may be the moment where the West realizes the metal is simply gone. This analysis is for educational purposes and it reflects a hypothetical market scenario. Precious metals involve high risk. Consult a certified financial advisor before making any allocation. The trend suggests that the global speed or paper-to-physical ratio is being tested by a geopolitical force that has no interest in settling for cash. In this macro environment, evaluating silver is not just about tracking a price chart. It's about understanding a global transfer of tangible power. Critics often argue that a global industrial slowdown would crush silver prices, citing reduced demand for solar panels and electronics. However, many macro analysts suggest this perspective ignores the liquidity trap. While industrial demand may face headwinds in a slowdown, the monetary premium historically compensates as the financial system enters a period of currency debasement. As of late 2024, the silver market is defined by paper shackles, a system where hundreds of paper ounces are traded for every one physical ounce held in a vault. In a true recessionary shock, the leverage in these paper derivatives often creates a systemic breaking point. When liquidity dries up, institutional participants often pivot from counterparty-heavy assets to atomic assets with zero default risk. Industry reports indicate that a recession doesn't necessarily destroy silver's value. It potentially destroys the paper manipulation system. As the paper-to-physical ratio collapses, the exchange is forced to reconcile the massive gap between digital promises and physical reality. This shift forces a move to physical-only pricing, effectively decoupling silver from traditional equity market cycles. This analysis reflects a hypothetical market scenario and is for educational purposes. In this environment, silver transitions from an industrial component to the ultimate exit ramp from a failing paper system. As of late 2024, the countdown toward the projected March 2026 delivery crunch has begun. Many institutional analysts are prioritizing frameworks for moving from digital abstractions to atomic certainty. The 60-day window represents a theoretical stress test for global exchanges where the paper-to-physical ratio may finally fracture. Experts are increasingly evaluating specific checklists, auditing physical holdings, assessing vault transparency, and distinguishing price speculation from systemic insurance. This analysis is for educational purposes. And while markets focus on digital growth, atomic infrastructure depends on a finite resource that cannot be printed. As the liquidity trap tightens, the question for 2025 is not just price. It is about who holds physical metal when the music stops.